This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Coveil. Not filtered, raw, honest. That's my passion. My guest today needs no real introduction for this particular podcast. For my Trend Following podcast, one of my earliest guests. He has appeared many times. He also happens to be, shall I say, the star? One of the main characters of my book, The Complete TurtleTrader. Today I welcome again Jerry Parker, President, CEO, founder of Chesapeake Capital. Jerry's early background, so unique across Wall Street. He is one of the original turtle traders. I always love talking to Jerry. He is a very, very thoughtful, pragmatic guy. I think you will appreciate his wisdom. And do also check out his Twitter feed. Jerry's Twitter feed is one of those feeds that if you're a Wall Street person, he's always finding something interesting. Oh, and one little PSA before I jump into this interview with Jerry. One little PSA. Check out my newest edition of Trend Following. 220,000 words. Get the hardcover version. Trust me. If you have any other version of Trend Following in the past 10 years, you want this edition. You just have to trust me on it. In fact, if you have any other edition, I dare you to buy the newest edition and then send me an email and tell me that it was a waste of your time. I don't think that's going to happen in any way, shape, or form. But in all seriousness, the book has been completely rewritten, expanded. It is the massive newest edition of Trend Following. With my PSA out of the way and without any further delay, nice little rhyme there, let's jump right in with Jerry Parker of Chesapeake Capital. Jerry, my first question is kind of a fun question. I just did a binge watch of the third season of Billions. Do you happen to be a fan of this show at all?
Oh, so much fun. It's like the most popular show in a while. All my friends, we all love it. Even I don't think it has much to do. I'm not sure it has much to do with real life hedge funds, or certainly the hedge funds that I know anything about. And I find myself not always rooting for the hedge fund guy. I find myself rooting for the person who I think is going to win and dominate the other person. So sometimes I'm Paul Giamatti. I'm loving on him and watching him. Looks like he's going to crush this bad hedge fund guy. So much fun. What a great show.
I'm very envious sometimes when I watch a turn of the phrase on there. Some of the writing, you just see, my gosh, the creativity is just amazing. Some of the lines, you just say, oh, I wish I wrote that. I wish I said that on Twitter, you know?
One of the great things about being in the hedge fund or trading business or having your own business is not having to shave every day and then not having to dress up. And God, that guy, the guy Axe, he never wears a coat and tie, shows up at fancy events. Maybe if it's black tie, he wears a black tie, but those T-shirts, those fancy T-shirts, what a great lifestyle he perpetuates on the TV.
Let me ask you there. I mean, you've been around occasionally some interesting events. And without naming any names, have you ever seen anybody that cavalier on the dress code?
I don't think so. I mean, I wish I was him. I wish I could pull that off. I like to wear jeans everywhere and be a little casual. And whenever I'm in those situations, I was in one recently. I was a little nervous because I don't want to be the only one there. And then all of a sudden, a friend of mine shows up with a golf shirt and sandals, and I was so relieved, so happy.
I even appreciate it. I take it a step further. I enjoy when he puts on the heavy metal T-shirts. He'll have something like a Black Sabbath or AC/DC on or something. Takes it the extra mile, and I'm like, oh, I'm in love with the attitude. But listen, here's where I want to jump in, away from Billions. I want to quote this from you, and you're kind of a fun guy to prepare for because I can basically go to your Twitter and jump inside Jerry's mind to prepare for a conversation with Jerry. That's a fair assessment, right? It's kind of what I can do.
Very fair. I think that every now and then I leave something I don't sarcastic. It's a little try to make fun of something, and I may not say, hey, I'm trying to make fun of this. So 99% of the time, yes, I think that's true.
So here's the one I want to quote you on, and you'll have to tell me if it's your original line or not. But I thought this was a great way to open up the podcast. And frankly, if we talked about this one line for an hour, I could be happy because there's a lot to break apart here. It's very subtle. It might not be subtle for those that are experienced, but I think for a large portion of the audience, it's probably pretty subtle. The line that I pulled off your Twitter feed, the final step for AI and machine learning will be to wait for the breakout. Is that yours?
It is mine. I don't know. I probably got inspiration from someone else, but that's mine.
I love that one. That's Jerry Buddha right there.
I'm proud of that one. It's a little poor English, probably, but I tried to make it succinct. Maybe it was a little too short, but I do think that what I was trying to say basically is, in my experience, and I think I'm anticipating, these algos that are AI or machine learning, I think they will put together some useful information, I'd say, and do something that trend following doesn't even attempt to do, of course. But then the final step in that buy, sell, go short, go long, should be, probably could be, let's just wait a couple of days or a few hours or whatever for some sort of price action, buy the high, sell the low, whatever. So let's wait for that breakout. It's a little sarcastic, and I know nothing about AI and machine learning, but I wouldn't be surprised if everything that we find and all the trend followers and CTAs find to be true about the markets, they're going to pick up on that as well. And it's nothing wrong with that. I remember reading a book, Market Wizards, and one of the guys in there is very smart and very wealthy and famous. It was in the first one. And I think he was talking about a Canadian dollar trade, and he was analyzing this trade, the fundamental analysis. And then he sort of said, yeah, it could be long, could be short. I guess I'll just wait to see which way it breaks out. And I thought, okay, I just forget that first part and I just wait for it to break out.
You're kind of getting the same place with your comment about AI and machine learning. You're taking the jargon of today, replacing fundamental analysis with AI and machine learning, maybe not one-to-one, but essentially it's what you're doing. And then coming back and saying, ultimately, but if there's no movement, if there's no price action, then what do we got?
And it works. I remember I had some bad ideas once, counter trend type trading we were researching, and profit objectives, take profits, it goes to everybody's mind, and you research this stuff, and it doesn't have any good statistical basis to trade this way. There's not a lot of sample size if you start concentrating on large trades. So we would just write this rule that said, if it's a large trade and it's gone up X%, get out, just take a profit. And of course, it looks great on the back test because the computer will go out and find that perfect spot, given the historical data of where you should exit. Sharp ratio goes up. It's just perfect. My research guy came back to me once and said, you can make it a little bit better. He said, that would be if you just waited to like 1 day lower, 5 days lower. So if you just threw in a little bit of trend on this bad idea, that increases it quite a bit because it works. Sometimes, you will get out at the high, and then sometimes you'll have another 10 or 15% to the upside before it goes to that 1 day lower, and then you can take your profit. Just the power of trend is everyone sees it, everyone picks up on it. You can't have it both ways. You can't say it's really crowded and there's lots of trend followers and then not expect people who make it their living to analyze lots of data to say, hey, can I just add this little piece of trend as well? It really seems to be a great timing mechanism.
Not that I approve of this, but it reminds me of athletes of the 90s, particularly baseball, that add steroids to an average player. All of a sudden you have something nice. Add trend following to kind of an average portfolio, you all of a sudden have something nice.
Very good analogy. I love that. Trend following is steroids.
You can send the wire payment directly to me.
I like that. I get a lot of good comments from my friends who text me and email me a lot of good stuff. I always ask them, hey, can I tweet that? I will put your initials on it in quotations. And I did that yesterday. And 90% of the stuff I put out there is not mine. You just happen to find one. And yes, I really like that. So I'm really proud of that one.
Well, I love the one about the AI. And I was just thinking as you were talking about, the notion of adding in trend. And I just had this conversation with Bob Enck, who you know. And so I was just thinking this whole idea, it's like nobody wants to talk about this great thing you're adding in, but everybody knows it's a great thing to add in.
That's right. I did some research projects with a famous research outfit, mostly stocks, but currencies and bonds and commodities as well, down in Florida a few years ago. And when I went down to visit them and talk about our research projects, some of the model builders, they would build models for institutions and traders and clients. He told me the story about how he would be asked to build these models based upon fundamental data. He would say, look, if you just let me add a little bit of trend to it, it'll make it so much better. And a lot of people would say, no trend, can't have that. It's a stigma, it's something going on. I think now that some people call it momentum and it's promoted by really smart people, momentum is not as bad a word as in trend following, I guess. Kind of the same thing.
I think maybe they just invent new words because people like you and I use the word already, so they need it's a marketing move. Hey, so here's another thing I pulled from your Twitter feed, and you were quoting somebody else who had posted it, but it was just a line from Bridgewater, and it was from, I guess, sometime probably in 2016. And the quote was, Bridgewater Associates expects a 10.4% drop in U.S. equities market should Trump win the presidency. Should Trump win the presidency? Well, of course, everyone knows that's not happened. We could break that apart for people, and some people are going to know where you're going to go with that. But I think the larger issue that I have there is I'm starting to wonder, and I see this across Twitter, when a firm is so big and so successful, it's almost like they're shielded from constructive debate or constructive criticism. Whereas if it was just some random guy making that statement, we all might have eviscerated it. But if it's Ray Dalio, and I salute his success, one of the best success stories ever, it's an interesting thing where it seems like, how do I want to say this? There's silos a little bit, or maybe my perception's completely wrong. How do you read that? You posted the tweet. You didn't say much about it, but I mean, how do you see that when you see a quote like that from one of the most successful investors of all time?
Well, I mean, I think Bridgewater's pretty amazing, and they've survived. And that right there makes me think they appreciate diversification and taking small losses. I just took that quote as irrelevant that it was from them, but more along the lines of you just need to continue to make fun of predictions and then try to, whenever you can, remember that predictions are kind of dangerous. 0.4%, that was kind of funny. It's kind of like going to a cocktail party and talking about the markets and then someone saying, well, so you must be short the S&P. And I've had this happen. I've had brokers say, so you must be short the S&P. And I was like, oh, God, no, it's in an uptrend. And I'm long. There's two ways of talking. And, there's talking and then there is trading and investing. And so it's okay to separate the two.
But you don't do that personally, that your ethos is such that, I mean, I think that's what I love about your Twitter feed is if I go there, I don't really see any subterfuge. I see this guy saying, here's how I see the markets, here's what I do, but I don't really see any kind of big pronouncements about the stock market going up 23.456%.
No, I mean, one of the things that frustrates me about the stock market in general is that it's a great trend. There's been so many people that have talked bad about it. It continues to go up, and valuations and value and predictions don't work. But it's just a trend. So let's all, if you're a trend follower, like it, get on it, make your money. I think that we have a tendency to talk about diversification and crisis alpha and adding CTAs to your portfolio. And gosh, I wish the stocks wouldn't keep going up. So that, I think, is a mistake. Stocks are wonderful. They're great. They're part of the four sectors, one of the four sectors we trade. And thankfully, we have the stocks because the other three sectors are not doing that great for a while. And I think trend following per se is not managed futures. Trend following is trend following.
Managed futures can mean a lot of things.
Usually what it means is trend following currencies, commodities, stocks, and bonds, long and short. But trend following seems to be working darn well in the stock market. So I'm going to celebrate that. It's a one little beacon of hope out there. The CTAs in general who've diversified their portfolio with currencies, commodities have been punished for that diversification. Hasn't worked that well. We have on a lot of short trades now, which is never a good sign. Tell me about your wonderful trades. Well, I'm short silver, gold, and copper. Oh, darn. Yeah, you're right. we're going to make all this money, and we have made money, a lot of money in the past based on long trades mostly. So I don't have a bad thing to say about being long stocks or anything that's in an uptrend and has done really well, regardless of some sort of idea about crisis alpha and hoping stocks go down so people will give me more money. That's kind of silly.
Let me break something apart that you threw out a second ago. You threw a little shade on the concept of value. And of course, if the average listener hears value, they think of Mr. Omaha, who, again, I know by no means are you attempting to insult his investment success. I know none of us would do that. There's no reason for that at all. But it's an interesting observation to make about value. Why don't you try and unpack for the audience how that might work? Because if you were a value investor, and look, I'm not, but I would think that when you've had a 10-year run like we've had, what kind of style of investment could keep you in long at the top other than trend following? It seems like everything else would be saying, well, hold on, this is overvalued.
I'm not sure I'm an expert on value, but I do read a lot about the market is overvalued and it's expensive and things like that, and yet it continues to go up. So I think that's a problem. Once again, I'm in favor of anything that's a process and has rules and a strategy, and maybe applying a little bit of trend to value might help value quite a bit. Not value plus momentum or value plus trend, which a lot of people advocate. I'm talking about add a few breakouts to your value idea, because you can't predict these markets, and the markets are irrational. I mean, it's been overvalued. I'm okay with someone saying, won't you pay attention to science here and let me show you how it's overvalued? I'm like, I'm down with that. It's just been overvalued for 5 years or whatever. Let's just make money and not try to make it an opinion contest or an intellectual contest. It's a trading competition, and adding the trend and the breakout. I'll buy these value stocks when they're at the 10-day high, the 50-day high. I don't know. And they keep going lower. You save yourself a lot of money.
See, I think you're a wise, intellectual, smart guy, but in the way that you accept price, versus where I think most people, if they're imagining what a fund manager might do in the markets, they're thinking it's kind of like Axelrod. It's like Jerry Parker's at the screen using his brilliance on a moment-by-moment basis to know every lever to pull or push or prove, or to make happen. They think that's what it is, whereas it's something different. The intellectual part in your world is coming from a different angle, in my perspective.
Well, through trial and error, mostly error, you have to acknowledge that embracing the process and the rules is where you want to be. At the heart of a lot of fascinating people and successful people, football, athletics, coaching, acting, science, whatever. It's people who have a good process and have, thankfully for me, I've strayed off the rules many times over the years, but never been rewarded for it. Not a momentary success where I could say, oh, wow, got lucky on that one. I've always been punished and pushed towards going back to following those rules. And early on when I was trading for Richard Dennis and stuff, I saw lots of opportunities, lots of people who had the same experience, that not following the rules was always a bad idea. Even if it's a so-so rules, just follow them. And I think that's the most important thing, along with being conservative and trading small. Yeah, those are the two things that I was told in 1983. The most important things: follow the rules and trade small. And every time I've gotten in trouble and really regretted it, it was violating one of those two rules, or both at the same time. But yeah, that's kind of a sad situation. It's not a great story.
You don't make it sound sexy.
I'm always wondering if there's anybody out there who can do it better and do it different. Once again, I think there are people who do it different and better, but more than likely they have a good process. Just like Buffett, he has obviously a good process, good systems, good rules, sticks to them. That's kind of the key.
Hey, I know you're a huge fan of sports, and I know you like to look at the analytics of the whole thing as well. What's been most interesting to you in your reading and whatnot? What you pick the sport, you pick the player, you pick what you're interested in. One of the things I think is really interesting is in baseball, the guys that, with the way that the way that pitchers are throwing, the shifts they're doing, and that a lot of batters are figuring out to be really aggressive on the first pitch strike. And just, crunching the numbers and seeing how this all plays out. It's fascinating what's going on in baseball. What is intriguing you these days in the field of sports analytics?
When I first went to Chicago in 1983, I, at the same time, introduced to trend following and turtles. My friends there, some of them were showing me these books by Bill James, and I was introduced to baseball analytics at the same time. It was very fascinating and fun. And of course, now Bill James works for the Red Sox and John Henry, and baseball analytics is an incredible field. I think one of the things that's really interesting to me is happening in Tampa, my hometown, one of my hometowns. Tampa's sort of playing around with no starting pitcher. That sort of a reliever starts the game. And I think baseball over the years has gone from pitching, quote unquote, to defense. Now, pitching is part of defense, and pitching is not the defense. So the shifts, using pitchers in situations and starting the relievers and bringing in your best pitcher in the seventh inning with the bases loaded to stop that from getting out of control versus waiting for the ninth inning. And it's really, you can see it from the NFL point of view. I remember when Joe Gibbs inserted the nickelback the first time the fifth defensive back came on the field. People were horrified by this. Now there's this sort of shifting going on in baseball that really rubs traditionalists the wrong way, but it's really kind of fascinating to watch baseball change as much as it possibly can. And I keep up with baseball through, I recommend this Joe Sheehan newsletter, and I recommend that you have him on your show. He's a phenomenal writer and expert on baseball analytics.
I will absolutely take you up on that bit of advice. In fact, you mentioned John Henry, who I think in a past life was one of your peers in the trading world. And I know that when John pivoted and went from the trading world to the sports world, probably some of the press kind of, maybe not say such nice things. I think in the long run, his pivot and his trend following applications in sports has been a pretty good move, hasn't it?
Yeah. I mean, John Henry's kind of a genius, and what amazing life and performance he's had and continues to have. I don't know if it's trend following in baseball. It's certainly math and numbers and Excel and analytics. But so much fun. I love that that's part of baseball. It makes me like baseball. And baseball is unique in the sense that it lends itself to this pitcher-batter event that takes place, and you can total up those numbers and kind of get a better idea of exactly what's going on. But yeah, he was fantastic in the trading. I'm sure he still trades and still watches the markets. What an amazing situation to be in, to be able to take that love of numbers and gamesmanship and winning to a major league and then the soccer level as well. Really admire that guy. He's phenomenal.
What's so awesome about it, too, is if you say, well, gosh, would baseball really be baseball without the Yankees and without the Red Sox? And one of those teams is owned and controlled by either a former or a still trend-following trader. I think that's a really fun aspect.
Over the years, when John Henry was managing money, lots of money, usually more money than everyone else, he gave a handful of speeches over the years that were just incredible. And sometimes when the industry was having big drawdowns, and the way he was able to encourage people and set people right in their thinking, kind of like now where the trend followers and CTAs don't we get some criticism for lack of performance. That's really, what it takes is someone to, regardless of performance, just to sort of say the truth, which is we play a positive expectation game. Don't give up. We're losing money. People dislike us right now, but let's just do the next trade and keep going. Digging up some of his old speeches, they're probably out there, and some of the things he said were such an encouragement to me over the years. Very big fan.
Let me pivot from John, and I think what I'm going to pivot to would actually represent his past trading, which was phenomenal. But this is a line that I also pulled from your Twitter feed, which I think is great. And I want you to kind of just, when you hear it, I want you to tell the college audience that's listening, what does Jerry Parker mean when he says this? The best returns in life and markets are lumpy. What does that mean? I want straight line, Mr. Parker. I don't want all of that risk. What does lumpy mean?
It's worse than lumpy. Lumpy just means that you're not going to make 1 or 2% a month. It's a lot of losses and bad periods, and then you make a bunch kind of quickly. Exactly the opposite of what people would like. It's not going to be a good Sharpe ratio. But I think I read an article recently from Morningstar, was incredibly one of the best things I've read in a while. They did some analysis of real traders, and they did some hypothetical analysis to see if the hypothetical matched the real traders, and it did. And it basically said that after 20 or 30 years of managing money, the people who finished in the top 10% or so had the worst performance over long stretches of time. So maybe a 5 to 10 year period where they were near the bottom, and then that was what was required in order to be in the top 10% after 20 or 30 years. It wasn't like it was an option, because the opposite was true. Those people who did not have a 5 or 10 year really bad period, none of those guys were in the top 10%. It's mandatory to go out there and find. Can you imagine going to your research guy and say, no, here's a system that's not lumpy. The Sharpe is too high. It doesn't have extended periods of bad performance. You've got to go back to the drawing board. You've got to find a system that has bad performance that almost no one would be able to stick with. This is a requirement. It's a characteristic. It's a part of something that's good. I mean, it just gets worse and worse of what is required.
If I just had an energy meter there, that last 20 seconds of you, I could just see your face lighting up saying, I know this to be true, and I want the audience to understand what I know.
And encourage people, that get ready. This is what's going to happen. Embrace it. Like it. It's bigger than you. It's bigger than, here's a system. We've done research. Not only should you not feel bad through extended periods of bad performance, it's a marker that you're onto something. You're onto something good. And then embrace, how hard it is and how perverse it is and how you want criticism, and you want people to say it's dead, trend following is dead, or whatever you're doing is not working. You've got to have that, at least in the systematic approach that in the currencies, commodities, stocks, and bonds. I know there's Bobby Axelrod's out there who, I guess he was starting to get in. One of his guys was starting to get involved with algos and stuff. But I think for the vast majority of us, embrace the pain. It's a good sign.
Let me get a big philosophical one out at you to open up. I know this is kind of in your wheelhouse. I know you've kind of talked about it some. So your governmental designation is often a CTA, commodity trading advisor, kind of a misnomer, doesn't exactly describe what you do, but hey, that's the regulatory term. Why don't you talk about the notion, though, of the traditional portfolio, the typical 60-40 stock split? Why don't you open up the thought process to CTAs perhaps bringing in-house more than their component they typically contribute, the 10% alternative component. But why don't you break this open and put on the table the idea of CTAs doing more with the traditional 60-40 split, actually the application of your techniques to those assets as well?
I really dislike the whole idea of crisis alpha. It makes no sense whatsoever. Yeah, I think it was invented by some people who don't really like CTAs. Crisis alpha, it's a bad idea. It's silly. It doesn't make any sense. In order to provide crisis alpha, we'd have to trade suboptimal systems. Would have to be really short term. We'd need to get short that S&P really quickly. Shorter term trend, at least that I know about, it doesn't work very well. I think the people who are able to add crisis alpha and make money all the time, basically, or take advantage of really short term moves, especially shorting stocks or the S&P when it breaks violently, like February. Great. Great for you. I mean, you're a hero. You're amazing. You're way better than me and most of the rest of us, mere mortals. Go for it. But, I wouldn't say to add you as crisis alpha. Why, if you're that good and you're going to produce these profits on a really short-term trading idea, why bother with 60-40? Just give this guy and people like him all of your money. I mean, why would you do 60-40 if you really believed in a guy who really had a high sharp and made money very quickly and could help your 60-40? Why not give him the vast majority or create a kind of a portfolio of these short-term guys? Why mess around with crisis alpha? It doesn't make any sense. And most of the normal long-term trend following, medium-term trend following CTAs, they themselves kind of expect 5 or 10% of a portfolio at the max. Or how much crisis alpha is that going to give you? If you really want to do something about crisis alpha, let me trade your equities with trend following. Let me trade your bonds with trend following. Let me trade your 60-40 with trend following. A long, short, using a stop loss, taking small losses and having a trailing stop. And then I'll throw in a few currencies and commodities as well, as many as you'll let me, because that'll help us with diversification and making more money, because those markets are uncorrelated. But your problem, you've got a 60-40 passive long only, let's say, or whatever, with your equities. Therein is your problem. You've got a dysfunctional idea, a dysfunctional portfolio with no risk control, no process, no plan except to buy and hold. And then you say to me, hey, here's 5%, crisis alpha me. What? No, I don't think I can do that. It's like going to the doctor and saying, okay, you're giving me this bad report, fix me, but I'm not going to change my bad diet. No, I mean, I'll try. I'll nibble around the edges. But trust me, let me get in there and do what's right for all of your portfolio. That's how I can add value. That's how we can add crisis alpha, by putting a trailing stop on Apple, Amazon, etc.
Can I sum this up that you just took on the role of Manny Pacquiao in his prime? You went into the ring and you threw about 30 different punches that a lot of people in your particular position might not throw. So you seem to be very comfortable with the intellectual joust here of saying, hey, let's put it all on the table. If we're trying to win and we're trying to be intellectually honest, then let's be that.
Then at some point in time, the next 50% drawdown of the S&P, which will recover after a few years and go back to new highs again, a repeat of 08 and through 18, I have no problem if that's what happens, or assuming that might happen again. People are going to say, do you want people coming up and saying, why didn't you advocate what you knew to be the truth, which is you should use a systematic approach on all of these assets? Why are you just sitting there groveling for 5 or 10% when you know better? I mean, how many long-term, wealthy, multi-billion-dollar CTA funds with PhD research staffs who can do whatever they want to do to add value to the clients, with carte blanche to create systems and portfolios in any way? I do too, and I'm not large. But how many of these guys are out there saying, we have done our analysis and we agree that we need X% passive long-only S&P or stocks in our portfolio? That's going to make things a lot better. Zero have said that.
Well, what's the fear, Jerry? What's the fear?
No, there's no fear. Their analysis of the markets does not dictate that. They have no reason not to do it. There's no fear. They could just hide it in there and say, we've looked at all these markets and all the arguments, and we too agree that we should have a large passive part in our portfolio that's going to make our overall performance better. I don't see anybody advocating that, even though they can do it and they have the resources to prove whether it's true or not. No one really believes that to be true, I think, amongst the CTAs or the hedge funds that use a systematic approach. It's not true. It's impossible to trade a systematic approach with a medium to long-term system and add in a few currencies, commodities to the stocks and bonds and have a performance as bad as 8% on average and a 50+% drawdown. It just is impossible. We can't do it.
As we kind of keep tearing this apart, let me throw at you a question that I saw you post. You said question of the day. You had two questions. They were kind of a little I guess they're the same one essentially, but the second one really caught my eye, and I would love for you to kind of give your perspective on it, and maybe we'll tear back into what we were just talking about there also. What single sentence describes what most investors really want? Because we can talk about all the managers and whatnot, but what do investors want, and do they know what they want?
Yeah, that question was a little confusing. Didn't formulate that perfectly. I think that what people want that's a whole nother can of worms. But I guess what I was trying to get at was how would you describe what you're trying to deliver to your clients? What is your edge and what are you trying to do? What should people kind of want? And I think for me, it was more of a risk controlled experience like trend following will give you without in less risk than this S&P we keep beating up on, but without any lost opportunity for profit. So I'd like a little more risk control, smaller losses and smaller drawdowns, but I don't really want to give up a great deal of upside potential. For many years, I think that's what the CTAs offered. They demonstrated that in the currencies and commodities and bonds, they ended up performing very well compared to the stocks. And that just hasn't been the case recently, where it does look like the stocks are superior markets, superior trending markets. I don't think they are. I don't think they will be in the long run, but it certainly looks like they are. I think that's the ultimate question that everybody should ask. What am I giving up if I diversify, if I go into the typical CTA portfolio with long and short currencies, long and short commodities, plus the stocks and bonds? It does look like I'm really giving up some upside potential. I appreciate maybe the extra risk control I'm getting with more diversification with shorts, small losses, but it does seem like it's awfully easy just to own a passive index and pay almost zero for that and make more money. That's really the issue, I think, is that going to continue to be the case, or are we going to revert back to the 90s and early 2000s where CTAs made more money and had less risk?
Let me go even bigger picture with you for a second. I've just got this thought that's coming to me. I think about the subject of trend following, and I say to myself, okay, give me the other strategies that are as well researched with so many available track records that one can look at for evidence going back decades. I mean, for those people that might not know about the proof that I'm talking about, it exists. Do a few searches, you can figure it out. So if we take trend following and we compare it to the something else, and let's put aside for a second Warren Buffett, let's put aside for a second Ray Dalio, two great investors with their own thing and so big that they're just almost something else. And let's put aside the Bobby Axelrods of the world, and let's put aside high frequency trading. I mean, we don't get to be in the trading room at JP Morgan, so I don't really know where that does anything for the average investor. If we have to compare trend following, excluding those four, what are the other trading strategies that match up with trend following?
That's a good question. But I think to some degree, I don't think we can rule out the possibility that trend following won't work very well. Maybe it can be torpedoed. I think the CTAs themselves will be the culprits of too much volatility targeting, indiscriminate selling, crazy large orders going in and making the markets cotton crash or cocoa crash. And so I think that the CTAs themselves, the trend followers themselves, could easily create a bad trend following experience. And maybe that's partially what's happening. But once again, in the most important, the most liquid, the most watched markets out there, the stocks, trend following is doing well. Why? Because there's been trends. We shouldn't discount the possibility that in the same way, and we have this worldview, which we love what we do and we think it's great, but in the same way, the value people are saying the same thing. Are you going to buy these high-priced stocks? You've seen that they crash. We got to stick with this. It doesn't make any sense. We'll go down fighting. We'll go down to the death with our worldview. I look at it a little bit differently than other alternatives. I look at it itself, and I say, let's break down the components. Taking small losses. Are we going to start taking big losses? Is that the key? I don't think so. Are we going to start taking small profits and not participating in the big, huge outliers? That doesn't seem right. Are we going to pay attention to things other than price only? Well, then you're kind of in discretionary land and no sample size and no back test worth looking at and being very confused because even if trend following doesn't work, we see that other things that don't pay attention to price, they don't work either. Is the key limiting our diversification? No shorts, no currencies, no commodities, stocks only. Maybe we can make 6 or 7% and have that 50% drawdown ourselves. That doesn't seem right. So I think when you break down the components of what we do, it is a lot of risk control and a lot of things that I'm just not willing to not do. If we don't make money and we shop around and we make just a very small amount, and so be it. But I'm not going to increase my risk and change my worldview of how important it is to take small losses and pay attention to price and be fully diversified and play for the outlier trade. All the components and the characteristics of what we do are non-negotiables for me. Maybe in the same way that looking at value is something that the value people are not ever going to give up on. It just makes too much sense. And then maybe we'll all just be bypassed by people who say you guys are stuck into history and you refuse to be flexible. But I've never made a claim. I've never had a home of mine catch on fire or have a major problem, a flood. But it's not even a question whether I'm going to have insurance. And it's not a question for me whether I'm going to proceed in these markets in the safest, most conservative way possible, which is trend following.
You just mentioned your worldview, and I would love for you to describe what your worldview is, but I can only imagine that a lot of your worldview has to do with, my gosh, the future is uncertain, and my gosh, I can't predict it. And that seems like a very grounded worldview. You might want to expand on those and maybe add if there's more to your worldview.
That's it. It's dangerous out there, and you can't predict. And I don't believe that stocks are superior and the go-to investment all the time. You got to pay attention to the trend and protect yourself and be humble and conservative and worried about risk. So all of the things that I talked about over the past 5 minutes, that's my worldview. And I don't see that really changing regardless of performance. And I don't know that is a smart thing, but it's just how I'm going to proceed.
Hey, let me ask you one last question, kind of really a non-trading question. I've met you for the first time a long time ago, and I'm fairly introverted myself. I would probably classify you as fairly introverted. But I know you made many speeches over the 90s and into the 2000s, but not huge amounts. But I know in the last 5 to 6 years on this podcast, other opportunities to speak to people, you have put yourself out there on the line and offered wisdom, education, a lot more. What has been your experience? How has that changed your perception of communication? Because you really have changed a significant amount, at least when it comes to Jerry communicating with people. That seems like a big change for you versus earlier in your career.
I mean, the opportunities are greater, to be on a podcast or give a speech. I have a lot of opinions, and I think, especially as it relates to trading and very specific preferences, I think trend following is so powerful that if you go with the trend and take small losses and diversify fully, then it doesn't seem to matter. All of these things we all pick up on that we just want to die on, this idea of how we're going to do our business and what we think is correct. I read a lot more than I talk, and I read a lot about traders and successful people who have very opinions just as strong as mine. And then we're all 60, 70, 80% correlated. So to some degree, I think all of these opinions that I'm very excited about making sure everyone knows how smart I am and how much I am the true trend follower and pure trend follower.
Come on now, hold on. Now there's some Jerry Parker sarcasm because you don't do that. You are very humble about this.
It just doesn't seem to matter as long as you do the basics and the big stuff correct. There's nothing as important as trading, all the markets or all the good liquid markets. When you get a hold of these trends and you're just simply on the trend and you're making money, there is no system, there's no entry exit, there's no filter that is going to help you if you didn't catch that trend. Simply, I just did it, didn't feel like it, didn't like it, but I did the trade, and then there you go. And then when you don't do it, you sit back with all your computers and your intelligence and say, oh, darn, I guess the markets are kind of more important than almost anything else.
So cool that you got a chance to be exposed to that so early in life, huh?
Oh, I mean, what an experience. I mean, it was the smartest people, some of the smartest people on the planet, nicest, kindest, taught us everything we needed to know, put us in a room by ourselves, kind of sink or swim, but with a totally pretend environment, in a sense that here's your money to manage, and it's kind of all you have to do is do the trades the way that we've taught you to do them. If performance is not good, so be it. Who cares? These are our systems. We love them. They're great. You do what we tell you to do, at least philosophically. And if you do well by not following the systems, you're going to be in big trouble. And then if you lose money, well, we may give you some more money in your account. And so then when you get out 4 years later to the real world, this is not how clients act. It's so being in that environment, at least in the early years, and having that kind of encouragement, it's kind of like, here's nothing against teaching people to trade, but it is a unique experience to be there with someone like Richard Dennis and Bill Eckhart. It's just can't be replicated. You can't read a book and be a Marine. You can't read a book or read some lessons. It's not going to be as good as being there with the creator, the author.
You can say that confidently because there was only a small number of you there.
Exactly.
There wasn't thousands. Maybe we'll save this for the next conversation. It is an interesting point because, I started with tearing apart your world, and then it was like all of a sudden like, well, hold on. Who is this guy over here who ended up buying a baseball team? Who is this guy over here that ended up making an Ayn Rand movie? All these other traders that were unaffiliated with you guys that were doing something similar. So it's just, trend following is an amazing story. It's there are so many different ways you can go down the path. And look, there's big guys out there right now from the University of Chicago that are trading these concepts. So it's really an amazing, tough strategy to kill.
Yes, the importance of understanding that good luck and bad luck over long periods of time can make it look like you're wonderful or you're horrible and things stopped working. But to some degree, it's why it works is because it doesn't work as often as we'd all like it to. And we all have an inaccurate concept of what long-term is when it's time to sort of give up. There was a fascinating article yesterday read from Mark Hulbert, from 30 years has evaluated stock market newsletters, and grab that. It's really interesting. I tweeted 10 or 15 paragraphs from that yesterday. It was quite amazing that he learned those same lessons, that the most important thing was a process and sticking to it. And I think that whenever I tweet things, I get maybe 5 responses or 5 likes. And I'm like, this is just amazing. This is an incredible insight. 5 people will like it. But every now and then, I will tweet something that basically has that same message. You can do it. Stick to it. You're a normal person, but follow the trend and diversify. And I'll get 50 to 100 likes. That's what people are craving.
I'm sure you've seen this, but one of the reasons I think that happens, and I see it in my world too, is we might have a follower who's got a big following and a big engaged following. And then when they do a retweet, then boom, that takes off. Social media, oh my God, it's going to kill us all.
Yeah, I don't understand it.
Seriously. Hey, Jerry, the best place for people to check you out, Chesapeake Capital. Is there anywhere else? Is there anything you would like to tell people about in terms of what's going on in the business side of your world right now?
Our funds are growing, and I think trend following is still viable. Check out ChesapeakeCapital.com and RJ Parker Jr. 09 on Twitter. Stay out of trouble with the regulators. That's probably all I should say.
Jerry Parker, so understated. Trend following is still viable. I don't know, you can put that tattoo across your chest or something. Trend following is still viable. Jerry, I appreciate you taking the time today.
Michael, thank you very much. It's always a pleasure.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.